Hi, everyone. Thank you for taking time in your busy schedules to join us on today's webinar about Eleanor Rigby, a 43-unit investment opportunity in Salt Lake City. My name is Dr. Calvin Lowe, and my wife, Peggy, and I are really excited to be partnering with Brian Briscoe in Streamline Capital Group. But before we get to Brian, I'd like to give you some information about myself, and I hope this will be helpful to those who are considering investing for the first time. Many of you know that I'm a pediatric emergency medicine physician and the medical director of the Children's Hospital transport team. It's been a 30-year career, had the joy of having the positive impact in the care of the most critically ill children and providing security to the patients. I've also had the numerous hours of overnight ER shifts to the 24 to 40-hour transport shifts. And, the demanding schedule has really taken its toll on me. And one thing I could have is to have back is time. The time I didn't have to spend with my wife and kids. And I'm sure that they've had the same type of thinking too. And I really paid the price and missed out on many special moments. And I'm sure many of you have busy schedule and feel the same way I do, wanting to have that valuable time back that you have by missing with those special people in your lives. Peggy and I have seen firsthand how investing passively can have an immediate impact to your lifestyle. So passive income has been working hard for us. So I won't have to keep working so hard. And some of you may have a reservation of taking that first step, but we're passionate in helping others achieve their goals. In fact, I wish we could have started this 20 years ago. I'm committed to putting an end to losing out on special time with my immediate and extended family. So it is my hope that the information provided today will help you in your path to passive income. So it's now my pleasure to introduce to you Brian Briscoe, who's the founder and visionary of Streamline Capital Group. He's also the host of the Diary of an Apartment Investor podcast and the founder of the Tribe of Titans, a multifamily educational community. I consider him one of the heavy hitters in the multifamily apartment space today. So Brian, take it away.
Hey, thanks a lot. I very much appreciate what you said. And if I could add to what Dr. Lowe said about, getting into the space and the advantages of it. If you rewind about 7 years ago, I was, my job took me away from home. I was traveling a lot. I had missed one more birthday and I was about ready to miss another, big holiday coming up. And, similar to what he just said, that was my goal, was to be able to spend more time with my kids. And we're not, 100% where we want to get yet. But we are to the point to where, we live where we want and, invest where it makes sense, but, that said, I am going to share my screen and we'll talk about the Eleanor Rigby apartment investment opportunity. So let's see, screen shared. All right. And Calvin, can you see that?
I can. It's perfect.
Okay. So what we're going to talk about today, and oh, by the way, maybe I'm just a bad salesman, but I like telling people, what I want them to do at the very beginning. So we're going to present this investment opportunity, and the ask with the investment opportunity is that you invest with us. Okay. Typically, when we put investment opportunities like this together, the general partnership, which Dr. Lowe and I are both part of, we all invest into it, and so like I said, it's investing with us, not investing in our deal. So in this case, this is an apartment complex in downtown Salt Lake City, and there's lots of good reasons. We'll go over why Salt Lake City is a great place to invest. It's a 43-unit apartment building, and the minimum investment amount is $50,000. All right, and it's that is the minimum. It's not the maximum. I'm putting in $100,000 into this deal because I do like it quite a bit. So this is just going over the wave tops, give you an introduction to the deal, and we're going to talk about a lot of this stuff that's on this slide later on. We are going to go into the numbers as well, but once again, 43 units, B-class apartment. And if you're not familiar with the asset classes, the really brand new, nice, modern apartments that are in great locations are typically A-class apartments. These are almost like letter grades. Okay, C-class apartments are on the other side of the spectrum, though technically there is a D-class, but C-class apartments is where about 60% of the apartment complexes nationwide are. You know, they're 25 years or older, and don't have, you know, the amenities, and don't have, you know, haven't been, you know, kept up maybe as well. All right, this is a B class apartment for a couple of reasons. It's much older than 20 years old, but you know, as we'll discuss later, it has been completely gut renovated. So once you walk through the front door, everything is brand new. One of the biggest selling points, and this is the box on the top right of the screen, you know, a lot of people, you know, it's October 2023, I almost said 22. It's October of 2023 right now, and prevailing interest rates for new loans are in the low sevens in the multifamily space. And we are assuming the sellers, the current owners' existing loan, which has a 3.1% interest rate. Okay, and this is part of what makes this deal such an amazing opportunity. All right, now the next row down, you know, we look at our returns, and this is what we're expecting to do over, you know, roughly a 20-year period. We'll talk about the timeline involved. You know, we underwrite the 20. It doesn't necessarily we're going to hold for the whole 20 years, but we'll talk about that later as well. Average annual returns, you know, we're hitting for mid to high teens. Okay, that's where we want to see things before we say, hey, this looks like it's going to be a good deal. All right, and we're expecting that over the life of this opportunity, we're going to somewhere between 3.5 to 5x your money. Okay, and there we can sweeten those numbers up a little bit. We're talking. We'll talk about a strategy to make those numbers look a lot better. And IRR, if you're familiar with that term, you know, we're looking at mid-teens on that. Now, one thing that we'll talk about a little bit more is we do want to return investor capital back to them in less than 5 years. So, you know, if you invest $100,000 with us, you know, within the first 5 years, we're going to, you know, push to refinance and get you your money back so you can start using it in other places. And of course, you know, we're going to let you stay in the deal. I think it'd be disingenuous to do otherwise, but we'll give you your original capital back. You'll preserve the same amount of ownership you have in the deal. So this is just the overview of what we're doing. Oh, and of course, distributions are paid quarterly, starting at the 6-month mark, and this deal is going to cash flow. So hold on a second. Oops. Let's just ignore that slide for a second. All right. So this is the team at Streamline Capital Group. We are partnering with Dr. Lowe and PEACEQuity on this one as well. But as far as our team, you know, I'm at the top. Since writing this slide, it says a general partner in 1,100 units. We've closed on a couple of properties, and that number is actually right around 1,300. I guess I should update that one. But I've been in the multifamily space for about 5 years now. This will be the 16th or 17th property that we close on, depending on, you know, which of two properties closes first. But you know, the core team you can see right here. We have Shyler Shoemaker, who is our acquisition specialist. You know, he's the one that was dealing with the brokers to find the property, doing all the underwriting. He's got a bachelor's degree in finance from Brigham Young University, and spent a good amount of time as a financial advisor with Morgan Stanley Wealth in Salt Lake City. He actually worked about 3 blocks away from where this property is. And then Adam Weiss is our director of investor relations, very much an entrepreneurial background in sales and tech especially, but has also had some real estate investment companies of his own. One thing that I do want to point out is our core values on the lower left, if you're following on the screen. And these core values are what drives us and what runs, you know, how we choose to operate. So we're proactive and we're driven to succeed. Okay, so we're not going to let properties, you know, just sit on the vine. You know, we're going to make sure we're doing everything we can to make sure these investment opportunities are producing fruit. All right, we're also focused on the long-term growth. You know, I think right now, especially where we are in the economy, the shift shift from short-term thinking to long-term thinking is prevalent. And quite honestly, I think we need to keep that long-term growth in mind, especially when we're doing real estate investments. All right. Next core value is we are team players. Okay. And what I mean by that is, we're focused on championships. And to use a football term, we're focused on championships and not necessarily Heisman trophies. Although we'll take a Heisman if we could get it, right? But that's what we're focused on. Okay. And the last thing is, we're here to win, not just play the game. So those are the core values. That's what drives us whenever we bring new partners or properties or employees into the business. Those are the things that we look at when we're making these decisions. All right. Okay, the promise that we give is, we're looking for these investment opportunities in a very vibrant Salt Lake City metro region. I won't go into my college loyalties because Cal, I'm sure you got a couple of USC fans there. But what our approach does is it allows us to maximize long-term potential on these properties and generate what a lot of people call infinite returns. Okay, and what do I mean by that is when you look at return percentage, you take the amount that you get back and you divide it by the number that you have in, and that gives you a return percentage. Well, what we're doing right now is we're going to give the initial principal back within the first 5 years, and that makes the denominator zero. So what you end up getting is a cash flow or an income stream that continues to build year over year. And then you can take that initial principal, reinvest it elsewhere, and potentially set up a second income stream. So we've done the math, and it's a slide that's not in the slide deck, but with one $100,000 investment, we forecast that could be turned into $1 million in equity and around $60,000 in cash flow in roughly a 20-year period. And the way that you do that is when we do the refinances and we push money back to people. If you were to take that money and reinvest it into something exactly the same as this property or similar to this property, and continue on, you can turn one investment into two investments into four investments into 8, and so forth, and just stack income streams on each other. Okay, so that's how we set up this particular structure, is so that people can stack investments on top of each other, take advantage of real estate over time, but still keep the velocity of their money high. All right. Now here's my history with investments. And I made this slide about a month ago. We have sold one more property that didn't make the cut on this one. But fortunately the numbers were actually really solid. So we have currently had 8 deals that have come full cycle. This city view is actually 2 of them together. But end of the day, our returns we've had solid returns on everything. I would like to highlight the one that didn't. This is one that COVID really affected. We bought this a couple months before COVID shut everything down. And what we ended up with is about 6 to 8 months of extremely low occupancy because we had kicked a lot of people out to start doing renovations. And then when COVID closed everything down, we couldn't move people in and we couldn't get crews in to do it. So end of the day, we were able to salvage it with a 9% average annual return. But everything else, we've exceeded our projections. And so there's the history so far, and up until now, we closed on one 2 weeks ago, but we're at roughly 1,300 units with 8 deals going full cycle. All right, now let's talk about the Eleanor Rigby itself. Okay, the apartments, and I'm going to like to point out the address here. It's 125 South, 300 East. Salt Lake City is very much on a grid system, and 0, 0, if you remember back to your high school algebra, 0, 0 is the city center. Okay, so this is 1 block to the south, 3 blocks east of the city center, which is exactly where it is. Okay, we've already mentioned it's 43 units. It's a 1929 build, and when we see some more pictures of the exterior, you're going to see, just how beautiful the building is. All right, it was completely gut renovated and brought up to current day code in 2019. All right, so the benefit of this is, it's extremely well located, 4 blocks from the city center, very conveniently located. And you know what? I think that's my next slide. So we're going to talk about that. I'll just click the slide and talk about it. So the property fundamentals is where it's at. If you're looking at the top left graphic, you see right behind it, University of Utah is up there. And I guess, with college loyalties, I am a Ute, but you can see how well located it is within the city. And then the middle picture is, looking towards the west, where you can see the urban core city center. But the location is amazing. All right. So it's a very desirable location. The rental market is thriving right now. The market vacancy is about 3%. Okay, which is actually quite high compared to what it's been over the last couple of years. But 3% vacancies where we're at, which means there's a big supply and demand imbalance there. All right, a lot of demographics. We're going to talk about where the city's going. The location's amazing. We've got another slide on that one. But we have very strong fundamentals on this property, both on location, as far as where it sits within the city center, and also in the market and submarket. So let's look at Utah and the greater Salt Lake City area first, and just look at some recent press that has come out. Okay. And Calvin, I'll make sure you have the actual slides, because these are hyperlinked in the slides. The state of Utah has about 3.4 million population. The greater Salt Lake City area is 3 million out of that 3.4 million. Okay, so I'm going to make a leap from, what we see on this slide are things that are true about the state. I'm going to make a leap and say these are true because it's happening in Salt Lake City. So Utah was ranked number one was ranked as the number one economy in the nation by the U.S. News and World Report. All right, ranked number one in job growth by U.S. News. Okay, ranked number one in trailing 5-year GDP growth rate. All right, ranked number one on economic outlook. Okay, and there's different sources. This is pulled from a variety of different sources. For example, the U.S. Chamber of Commerce said that it's the number one state in high-tech job growth. Okay, among a bunch of other things. In fact, I just went to the Silicon Slopes conference last week, and the tech industry in Salt Lake City is booming. All right, it's ranked number 5 in economic diversity, and after posting 5 or 6 number ones in a row, that number 5 looks terrible. But 5 out of 50 isn't bad. And when I put the slide together, it was ranked number 6 as the lowest unemployment rate in the nation. So that's what you have going for it. Now, location, it is in downtown Salt Lake City. There's a lot of reasons people come to Salt Lake and people live in Salt Lake. It's a lot of people are familiar with the LDS Church. Some people call the church the Mormon Church. But the Church of Jesus Christ of Latter-day Saints is headquartered in Salt Lake City, which is a big driver of both culture and the economy as well. And the church headquarters, about 4 blocks away from this property. All the government headquarters, the state capitol is there as well. And of course, you can't talk about Utah without talking about skiing, snowboarding, winter sports as well. We're not very far from Park City, Utah, which is, I know, where a lot of people like to go on vacation. From this property to Park City, no traffic. You can get there in 30 minutes. And from this property to the ski resorts, 45 to 60 minutes, depending on traffic. Okay. Now we start looking local. Eleanor, Rigby, right here, the one with the star on it, very close to the downtown core. You have City Creek, which is a big open air mall. Lots of dining, lots of shopping, lots of things to do. University of Utah, dozens of museums, all the cultural things are right downtown. but where it's located, it's extremely well located. And I spent a couple of days last week at the Delta Center, a mere 6 blocks away. So lots of stuff that can be done in the immediate area. And like I said, extremely well located. And one thing that if you pay attention to what's going on in Salt Lake City, right here on the screen, left-hand side, you have the downtown area. On the right-hand side of this map, almost in the center of the screen, you have the University of Utah. The big path of progress is between the two. And most of the growth, it's mostly urban infill. A lot of the growth and development are happening right on this corridor. And that's exactly where this property is located. So the location is absolutely amazing. All right. Now, Salt Lake City. We talked earlier about the job diversity. When you look at the chart on the left, each different color represents a different sector. Okay. And what you'll notice is there's not a single sector that dominates like you see in some other cities. Okay. So it's a very diverse economy without a single sector that really, really dominates, which means during an economic downturn, if there is one, not all areas are going to be hit, which means we're more likely to pull through economic downturns. All right. So if any one or two areas is hit hard, we've got other areas that can carry the economy. All right. Now let's talk about, once again, the local dynamic with respect to, numbers and rents. Okay. So it's a city that isn't really saturated with multifamily. And one thing about Salt Lake is it has a very young population. By the numbers, the state of Utah has the youngest population in the 50 states, average age of about 30, which means there's a much larger demand for apartments. Okay, but like a lot of other areas in the nation, there's not nearly as much supply as there is demand. And there's just not enough apartment buildings for everybody who wants to rent. Okay. Anecdotally, both of my daughters, live in Salt Lake. They're in their 20s, and every time they decide to move, they literally have to take the first available apartment offered to them. Most property management companies aren't returning calls to prospective tenants, and that's because they're getting 5 or 10 applications for every vacancy, and it's hard. It's a very tight market to get in. Like I mentioned earlier, 3% vacancy, which is high for the last couple of years. All right. Now, average rent price throughout the city, throughout the area, is about $1,670 a month. The average rent price in this particular building is $1,250. Okay. We feel that when we look at this property, we have to evaluate exactly where it is. So looking at the picture, the one with this really clean, nice new white roof right here is the building that we're buying. All right. You've got some brand new apartments all over the place. All right. So when you look at the average rent prices, what really drives the rents up are these newer apartment buildings that are built all around the place. Okay. And that's what's happening a lot in the area is buildings are getting, bulldozed, and brand new stuff is coming up. So we're not going to hit this 1672. All right. We think we're going to be a little bit lower than that number because it is an older building, but it is still B class. So when we look at all the A class comps, those are the ones that are pushing the rents up. We think this is going to be slightly below the middle of the road because most of the other apartments in the area are A class apartments with higher rent points. And we think this is going to be a perfect place for, people to live that want a little bit more affordable options with the downtown living. All right. And there's plenty of people like that. One thing that we like is the average household income for the entire city, not for downtown. The downtown income is actually higher, is about $81,000 a year, $6,000 a month. Okay, why this is important is because our rent points are less than 25% of the average take-home pay. All right, which means it's affordable for the people that live there. And we're going to be able to still push rents up, at least $100, $150 per unit within the next year. Okay. Once again, here is the market vacancy rates over the last couple of years. 2021 across the board, in 2021, the vacancy rate for multifamily was less than 2%. Okay, 2022, we saw similar numbers as 2021. And now in 2023, there's been a lot of new apartments that have come online, and the vacancy rate is up to, around 3% right now. But you can see over the last several years, 2019, average vacancy rate 3.4, 2.7, 2.6, 2.9. The average vacancy rate for all types has been, at least for the last decade, between 2 and 4%. All right. So, and we expect this trend to continue. What's really happening is the population and new household formation is outpacing apartment construction. All right. This is the slide that I moved to the front to give you an overview. So we've already talked about the numbers here. Now, one thing I like to talk about a lot, it's something that I've learned through painful experience, that you also have to protect your downside. Okay. And this is how we are protecting our downsides. Okay. Number one, it is a stabilized asset. Okay. It is going to be cash flowing from day one. All right. When we purchase it, we're looking at a 1.75 debt service coverage ratio. And what that means is, our cash flow is projected to be 1.7 times the debt payment. Okay. So number one, we have a lot of cushion there. Okay. We're going to be able to pay that mortgage. We have a 58% break-even occupancy. So our occupancy can get down to 58% before we're going to have trouble paying the mortgage. Okay. And if you see market occupancy is 97%, it would take a near catastrophe for that to happen. So it is stabilized, it is cash flowing, and that's going to keep us in the black. All right. It is lower leverage. Now, there's pros and cons to coming in with lower leverage. But we're going to get a $5.8 million loan on $10.8 million. It's a $10.1 million purchase price. We are, coming in with some substantial reserves, which is another risk mitigation point, but we're at about 54% loan to cost on this one, which means, once again, we have a lot of room. Okay. We have a lot of room to move before. I think right now, if you're looking at the headlines in the multifamily industry, there are some big notable failures and foreclosures. The chance of us foreclosing with, a loan that's half the price of the current building is extremely low. We already talked about the interest rate. Part of what, like I said, part of what makes this thing work so well is we are getting 3.1% interest rate. We actually had we had a lender come in and look at this property from a new debt perspective. They offered us about $6 million on a loan at a 7% rate, and we're getting this with a $6 million loan, rounding up, with a 3% interest rate. So killer terms on this one. And one thing I haven't mentioned yet, and I apologize, we've got 8 years left on the loan term that we're assuming. Okay. Normal loans in the multifamily space come in 5, 7, 10, or 12-year terms. All right. This was originally a 10-year term, and we are purchasing it with 8 years left on the term. Okay. Now, speaking of, one thing to talk about that I don't think is in the slide deck anywhere is the seller's motivation. Okay. And I think this really does come into play because if you're tracking what's happening in the space with rising interest rates, a lot of people are in trouble, especially developers. Well, this seller does big value add projects. Okay. The current owner / seller is the company that did the complete gut renovation. They did an amazing job on the interior, but they also have a lot of other projects like this in Salt Lake City and in the Intermountain West. Okay. They've got a couple of projects that have stalled because of where interest rates are right now. Okay. Basically, they've run out of cash on other developments, and they have a really high debt service that they have to keep paying. So they're selling this one to release their equity. They're going to net about $4 million on this property when all is said and done. and they're releasing that equity to keep other projects moving forward, which ends up being our gain, because we were able to buy this at a pretty good price. Okay. Calvin, how are we doing? Do you have any questions yet? Anything that I haven't addressed?
Yeah, it looks exciting. Yeah, you can just go ahead and continue on. I'm really excited for you to talk about the amenities.
Awesome. Yeah, the amenities, it's been very well renovated. You start looking at everything on the inside, and it's just very well done. And the finishes are absolutely amazing. We have solid surfaces on, countertops, in the bathrooms. Very well done with the laminate vinyl. We have, tile in the wet spaces in the kitchen and the bathrooms. But as far as what everybody has, the current owner did go on the high side as far as putting the amenities in. So stainless steel appliances. They have gas stoves, which is something you don't normally see in even B-class apartments. Okay, gas stoves you'll typically see in a lot of the A-class apartments, but we got stainless steel, we got a microwave, we got dishwashers, we have the fridge, and like I said, the gas stove. So when you start looking at the types of finishes and features you see inside, they're all very well done. Washer and dryer in every unit. It's the top bottom stack, and it's in, it's depending on what unit configuration it's basically in its own enclosed space, so you can turn the laundry on, shut the door, and not have to see it or deal with it. Fitness center, and when I walked in, most apartment fitness centers have like a treadmill and maybe a couple of dumbbells. This one is a gym that I would actually use. Okay, and that's one thing that I noticed walking in. And it's got battle ropes, it's got a lot of very functional fitness type items. The step up boxes, plyo boxes, that's what they're called, kettlebells, dumbbells, a lot of good stuff for functional fitness. And something I don't think I've ever seen in an apartment complex before is a dog wash, an inside dog wash. Salt Lake City does get a little bit chilly in the wintertime. And so, if you need to wash your dog, you take them downstairs, and it has soaps and everything else around there for. Partial lockers, gated parking, which is something you need in an urban area. But, drive in, have an opener or type in a code to get access to the parking lot, and the parking lot is in the back. So once again, we also said the average rent per unit in place is about $1,250. Market rent average is about $1,600. And like I said, we're going to push rents up significantly, but we're still going to be below that market rent, the average market rent number. All right. Now, just recapping our strategy, we are coming in with low fixed rate debt, 3.1%. Okay, what this allows us to do is not spend as much money on interest, okay, especially with this 3.1% rate. Okay, we're going to be able to provide steady cash flow to our investors. Okay, the combination of the low leverage and the low fixed rate debt means we are cash flowing from day one. Okay, we're expected to distribute about $250,000 in our first year of operations. Okay, prime location, the downtown area is buzzing. I mean, there's a lot of growth there, a lot of excitement about downtown. Both the city and the church are very committed to making the downtown space, keeping the downtown space in amazing, they're just making it a great place to go visit. All right. And that's going to keep the occupancy high, and it's going to keep the rental amounts high. All right. Growth in Salt Lake City is going to increase. Every projection I've seen says that, Salt Lake City is going to continue to grow. There are some projections, right now, and this is happening across the country. Rents over the last 12 months in Salt Lake have flatlined. But all projections are pointing that they're going to start going back up really soon. And if the Fed met, week and a half ago, kept rates where they're at, the longer we go without an increase in rates, the more likely it is that rents are going to go up and up and up even more. And if rates come down, we expect to see both values and rents, basically take off after that point. And then once again, we are going to do periodic refinances on this one. The goal is, around the 5-year mark on this property, we'll start looking to refinance around year 3, and we're looking for the ideal conditions. Okay, we're looking for rates to come down, and we're looking for values to come up. All right, we are not handcuffed by time on this one. We have 8 years on our loan. And so if it doesn't make sense to refinance, if rates are temporarily high or something's wrong with values, we can hold for a longer time. But, somewhere after the 3-year mark, we're going to start looking at that refinance opportunity. And as long as we hold the property, we are going to do periodic refinances. Okay, roughly every 3 to 5 years, we'll be looking for another refinance event. Okay, what does that mean to investors? It means big chunks of money coming back to the investors. All right, and speaking of refinance, I think our next slide goes through numbers. Oh, not quite. We're 2 slides ahead. All right. So this is what we call sources and uses. It basically says where the money's coming from, where the money's all going. Okay, so on the sources side, we are going to raise $5 million for this property, and we're going to assume a loan at $5.8 million. All right, on the uses side, our total all-in cost is $10.8 million. Purchase price is the majority of that, $10.1 million in purchase price. Even though it's now $200,000 in capital expenses, even though it's very well maintained, we are still going to come in with, between capital expenses and working capital, we're going to have $250,000 starting out, which is going to keep us solvent. We do have a handful of capital expenses that we expect. We are going to have to resurface the parking lot. And there are some small, there are some small things, but besides the resurfacing the parking lot, there is one other thing that we found during our due diligence. We are going to have to replace a section of the sewer, and we've already got a couple of bids on that. Those bids are coming in between 40 and 50,000. So, we're going to spend around 50,000 resurfacing the parking lot, and we're going to spend another 50,000, replacing that section of sewer. So we're going to come in with 200,000. Right now, we've got about $120,000 in projects, which gives us 75,000 for things that pop up. And like I said, working capital and reserves. So we're going to be extremely well funded on this one. A lot of closing costs come with a project this size, and we also, as is industry standard, put in an acquisition fee for this. All right, now here are the projected returns, and one thing on here is we have to project things. We have to put numbers to back things up. What we've said on this one is we'll just look at numbers all the way out to 20 years, and we're planning on refinancing periodically while we own it. All right, does that mean we're going to own it for 20 years? Maybe is the answer. Okay, so in the end, I am an opportunist. I think that long-term investments like this are what are really going to move the needles for most people. Long-term investments like this are what are going to create the generational wealth, what are going to create cash flow that's going to free us up. Okay. However, we are going to keep our finger on the pulse of the market. And, if we have another 2021, in the near future where prices just go bonkers, we may choose to sell earlier than this. But as far as our projected cash flows, we're looking at about a 3 to 7%, cash on cash return for the first 5 years. And with this refinance event, that'll push a big chunk of change back into the investor's pockets, into your pockets. Okay, so this is assuming $100,000 investment. We are going to do a 75-25 split between the passive investors and the general partners like Dr. Lowe and myself. But that does not trigger until we have returned 100% of your investment dollars. So the way we're going to do this is the first year we're projected to give about $3,000 in cash flow. That's on our ledger, on our financial statement, that's going to pay down principal. Okay, so we're paying down principal. And so you see about 3,000 year one, 4,000 year two, just shy of 5,000 year three, 6,000 year four. That money is paying down principal, which means that I don't get paid until we've returned $100,000. So with this refinance at year five, we're projecting to put, $85,000, $86,000, back into your pockets. And at that point, we'll have reached the $100,000, giving you your entire investment back. And at that point, we start distributing all incomes at 75-25. So 100% of all income goes back to you, the investor, until we've given you your initial investment back. We anticipate that's going to take roughly 5 years. However, if interest rates bottom out, in the next, couple of years, if we ever get back into an interest rate environment where, we're at a 3 or 4% in the next 3 to 5 years, we're going to do, number one, we're going to do a lot better than the projections. And number two, we'll be able to return your capital a lot earlier. Okay. So once again, deal structure, 100% of the income goes to the investor, goes to you until we've given you your initial investment back. Then after that, 75% of all incomes go to the investors, 25% is what we keep. All right. Here's a bunch of numbers on a screen, so probably better for you to look over the numbers, when you have this. But really, we are looking at a fairly conservative approach. If you look at our annual increases, they're not large annual increases. Okay. We're going from 811,000 to 870,000 in income. All right. That's not a big jump, 870,000 to 925,000. Okay. Once again, not a big jump. So when we start looking at our numbers and our projected growth, we're projecting a 4% annual growth rate. So far this century, Salt Lake City has averaged 7% rent growth per year. Okay. So we expect Salt Lake, all the indicators are pointing at future growth in Salt Lake. All the indicators are pointing at, supply and demand imbalances. And so we feel comfortable using that 4% projected rate. Of course, what's really going to happen is some years it's going to grow faster, some years it's going to grow slower. Okay, but we're just projecting a 4% income increase on a yearly basis, with the first year or two maybe being slightly more aggressive because we're going to bring rents up to market. Okay, here's our valuations that we're going to need to hit at our refinance points. And you'll notice, we're looking to just looking at our numbers. We plan on doubling the price between 15 and 20 years. So looking at that, can we expect real estate to double in 15 to 20 years? I think the answer, most people would say probably, is the answer. And that's what we're expecting, is the purchase price, or the value of the property is going to double somewhere between that 15 and 20 year mark. All right. Timeline. All right. I should have updated this slide. We now have until October 25th to close. And the reason for the delay, we had some, I think insurance issues are, kind of the name of the game in the multifamily space. I've closed on 4 properties so far this year, and 3 of those 4 were delayed because of insurance. The insurance game is just a little bit more difficult to navigate right now. We do have 2 what are called bindable quotes right now. So we've solved the insurance problem. But that did put us back on the projected timeline. And Calvin, I'll send you an updated slide deck with the dates in here. But we need to close by October 25th. And typically we ask for the investment money to be in about a week ahead of time. Okay. All right. Now, to invest, Calvin's going to send out a link to the investment portal. But once you're in the portal, you're going to see a screen that looks exactly like this. And really simple, you hit the Invest Now button on the bottom. It's going to ask you to set up your profile, put in your information. I don't know why it took me a long time to get that out of my mouth, but You're going to put in either your entity information if you're investing through an entity. We are open for all kinds of entities. If you have a self-directed IRA, self-directed, education plan, or any sort of self-directed money, we can take that. If you're investing with a trust or other type of entity, basically, we can take anything that has either an EIN or a social security number if you're investing through your own name. Okay. But you hit the invest, you fill out the information for the investment entity or yourself as an individual, and you type in your soft commit amount. Okay. When you put your soft commit amount in, it'll take you to the legal documents. All right. We have 3 legal documents uploaded. There's 1 document that you'll have to fill out and sign. That is, and what we have done is we've taken all the signature pages, all the important parts of these other 3 documents and consolidated it into, 1 document where all the signature pages are. Our attorneys have assured us that that is, common practice, and, we're able to, legally, push forward with that. So that the 1 document that you'll fill out and sign are excerpts of the other documents you'll see. And, some people want to send those to get, you can download those if you want somebody else to review, like a financial planner or attorney. Yeah, that's where to go from here. And incidentally, looking at this picture, I told you about some of the CapEx things that we're going to do. And I just realized one more that I missed. If you look at these timbers up here, some of these are getting old. We've got $15,000 in the budget to refinish or replace all of the woodwork on the front of the building as well. So, we want to make sure it pops and it looks really good. And oh, by the way, this is a dead tree up front, which is right over the sewer line. So we're probably going to remove that too. So looking to make this thing look even better than it currently is. But as far as investments, once again, the ask is that you invest with us. I feel strongly this is going to be a solid opportunity for years to come. When we first looked at this property and started digging into it, I literally told my acquisitions director, this is something that I want to own for the rest of my life. This is something that I want to pass on to my kids. All right. So anyway, that's it. And of course, disclaimer, I've done it. I mean, you guys can read the disclaimer, but I'll just say I have done everything that I possibly can to make sure the information that I presented was as accurate as possible. So that said, Calvin, do you have any questions? Is there anything that I missed?
Yeah, this is a 506B opportunity, right? So it's open to all investors.
Correct. All investors, we're limited to 35 non-accredited investors. So if you're not accredited and you want to invest, I would say hurry is the answer, because, with that limitation, we're probably going to fill up that number pretty quickly.
Yeah, I'm really excited about this opportunity because the low interest debt we're assuming. The Salt Lake City is a beautiful city. I've been there. The amenities, the conservative underwriting, as well as the infinite return. So thanks, Brian. Really appreciate it. Thank you so much.
Absolutely.
Here's our contact information. If you have any questions, Peggy and I will be more than happy to discuss this wonderful opportunity with you. Our final slide contains the links and the QR code to the PEACEQuity investor portal through InvestNet. Here you can register, place your soft commits, and read through all the documents. Remember, the deadline to close for this deal is coming up soon on October 25th. And slots are filling up fast, so it's to the point where it's now first come, first serve. Again, if you have any questions, please feel free to reach out to us. Again, I want to thank you for taking time out of your busy schedules to spend with us here. And have a great day, everybody.